On a Tuesday morning in March 2031, the unthinkable crystallizes into policy. President Marcus Reynolds, backed by a fractious Congress gripped by a populist fever that echoes Huey Long's 1930s thunder, signs Executive Order 2547 at 8:47 a.m. EST. The order suspends all principal and interest payments on the United States' $36 trillion national debt, a debt equal to 140% of annual GDP, a burden metastasizing since the 2008 financial crisis, when the bailouts swelled the balance sheet by $7 trillion in a single year. The rationale, delivered in a televised address that same afternoon, resonates with visceral simplicity. The American worker has been sacrificed on the altar of Wall Street. We owe nothing to Chinese creditors, to foreign banks, to the parasites who have drained this nation's future. Today, we reclaim America. The historical parallel is both seductive and calamitous. Argentina's 2001 default on $95 billion, the largest sovereign default in history at that moment, was preceded by similar rhetoric. National dignity trumps financial obligation. The peso collapsed 75% against the dollar. Unemployment spiked to 25%. Riots consumed Buenos Aires. Yet Argentina's GDP represented merely 0.5% of global GDP. The United States represents 25% of world economic output, 28 trillion euros annually. When Rome defaults, civilization trembles. By 9:00 a.m. in London, trading algorithms detect the catastrophe. The 10-year US Treasury yield, the benchmark rate for global borrowing costs, spikes from 4.2% to 12.8% in minutes, a velocity unseen since the 1987 Black Monday crash when the Dow collapsed 22.6% in a single day. The VIX Volatility Index, normally hovering at 15, explodes to 89 within the hour. Short-term Treasury bills, once considered riskless assets, plummet 40% in value as investors flee the burning building of American credit. The cascade is immediate and geometric. The S&P 500 index, a repository of $40 trillion in American wealth, enters free fall. Circuit breakers halt trading twice in succession as selling pressure mounts. By noon EST, the index has shed 18%, erasing $7.2 trillion in market capitalization, more than the entire economic output of the United Kingdom. The contagion spreads eastward. Tokyo's Nikkei plunges 15%. Shanghai's composite falls 12%. The DAX in Frankfurt collapses 19%. Foreign central banks, particularly China and Japan, each holding roughly $1 trillion in US Treasuries, face a historic reckoning. Their assets, once deemed risk-free, have evaporated. The People's Bank of China, blindsided, calls an emergency session. Panic sells begin within hours, dumping Treasury holdings at any price, accelerating the collapse. The dollar, the world's reserve currency backing 60% of global foreign exchange reserves, begins a structural collapse not witnessed since the 1970s stagflation crisis. By 5:00 p.m., the Fed convenes an emergency meeting. Jerome Powell, chair of the Federal Reserve, faces a choice that echoes the decision Paul Volcker made in 1979 when inflation threatened to destroy the dollar's credibility. Does the central bank monetize the default, effectively absorbing the $36 trillion debt onto its own balance sheet? Or does it stand aside and watch the currency collapse? Powell chooses monetization. The Fed announces unlimited quantitative easing, the nuclear option last deployed in 2008. It will buy every Treasury bond offered, extending an infinite backstop. The message is clear. Confidence in the dollar will be purchased, if necessary, with the entire money supply. This is the playbook of a dying currency, the path walked by Zimbabwe, by Venezuela, by Argentina itself when it attempted the same gambit in 2001. By midnight, the dollar has lost 22% of its value against the euro, the Swiss franc, and the yen. A $100 bill, which could purchase €100 at breakfast, buys €78 by dinner. Import prices for goods begin their inexorable climb. Oil, priced in dollars, becomes dearer by the hour as foreign producers demand more greenbacks for the same barrel, even as demand itself begins to crater from the shock. The Treasury Department issues a statement. The United States government is committed to meeting its obligations to citizens. Social Security, Medicare, and defense spending will continue uninterrupted. This is a lie that everyone understands. With revenues down 40% from economic shock and spending commitments exceeding $6 trillion annually, the cupboard is bare. The government will print money to fill the gap. Inflation, dormant since 2020, awakens as a monster. By 2:00 a.m. Wednesday, the first implications reach Main Street. Futures markets show oil at $180 per barrel, a 60% spike from $112 Tuesday morning. Gasoline futures suggest pump prices will reach $8 per gallon within weeks. Overnight, Americans' purchasing power has been gutted. A family with $50,000 in savings sees that nest egg shrink to $39,000 in real terms by Wednesday breakfast. Chapter 2. The First Ripple, 24 Hours of Reckoning. Dawn on Wednesday breaks over a nation in shock. Unemployment claims surge 400% overnight as businesses, facing collapsing demand and soaring input costs, announce layoffs preemptively. Boeing announces 150,000 furloughs. Amazon suspends hiring. Apple freezes expansion. The fear is rational. If the US government can default on its debts, what prevents corporate bankruptcies? The credit markets, the arteries through which capital flows to business, calcify instantly. The corporate bond market, worth $11 trillion pre-default, seizes as investors flee. High-yield spreads, which measure investor fear, widen to 2,000 basis points, a level last seen in March 2020 during the COVID crash. Banks, already fragile from years of low interest rates, face deposit runs as panicked savers withdraw cash. By 9:00 a.m. EST, the first bank fails. Silverside Savings, a mid-sized regional lender with $180 billion in assets, announces it cannot meet withdrawal demands. The FDIC, the federal insurance agency backed by the U.S. government's now suspect guarantee, scrambles to orchestrate a takeover. But the damage is symbolic and catastrophic. The bank run has returned to America. Videos of angry depositors queuing at branches flood social media, images Americans haven't witnessed since the Great Depression. By noon, the mortgage market convulses. Freddie Mac and Fannie Mae, the quasi-government entities that guarantee 60% of U.S. mortgages, announce they cannot meet obligations. Interest rates on 30-year mortgages spike from 6.8% to 11.2% in hours. A family considering a $400,000 home faces monthly payments ballooning from $2,700 to $4,200, an increase of $18,000 annually. Housing demand, which anchors consumer spending. Housing drives 15% of U.S. GDP directly and 40% indirectly. Collapses. Stock markets reopen for a half-day of trading at 11:00 a.m. EST, and the cascade accelerates. The S&P 500 falls another 12%, erasing an additional $4.8 trillion. The Nasdaq, heavy in growth stocks sensitive to interest rate spikes, falls 18%. By session's close, $12 trillion in American wealth has evaporated in 24 hours, equivalent to the entire GDP of the European Union. International markets are in free fall. London's FTSE falls 16%. Frankfurt's DAX drops another 14%. Tokyo's Nikkei plunges to its lowest point in a decade. Emerging markets, already vulnerable to dollar strength, they carry $3 trillion in dollar-denominated debt, face a different crisis. The dollar, expected to collapse, suddenly surges 15% as a safe haven trade, even as U.S. assets crater. Companies with dollar debts face crushing refinancing costs. Argentina's peso weakens 40%. Turkey's lira falls 35%. Brazil's real sinks 28%. By 2:00 p.m. EST, oil prices stabilize, but at $175 per barrel, up 56% in 24 hours. Airlines, with their fuel costs suddenly doubled, announce price hikes averaging 35% and suspend thousands of flights. Southwest Airlines suspends long-haul operations. United cuts international routes by 40%. The supply chains that power global trade, 90% of which travels by ocean freight, face disruption as shipping companies pause new bookings, uncertain of future demand and credit availability. At 4:00 p.m. EST, a statement from the People's Bank of China rattles the world. Beijing is considering strategic asset sales to shore up returns on its investments. Translation: China will dump treasuries and U.S. equities into the open market. Japan's finance ministry issues its own statement, hinting at similar moves. The implicit threat is clear. If the U.S. will not honor its obligations, foreign holders will not absorb losses quietly. They will flood markets with supply, accelerating the collapse. By 6:00 p.m. EST, Treasury yields on the 10-year note spiked to 18%, a level not seen since 1981 when Volcker's 20% rate strangled inflation. The cost of borrowing for American corporations has become prohibitive. Investment-grade corporate bond yields hit 12%. Sub-investment-grade junk bonds reached 22%. The debt markets are effectively closed to American borrowers. As night falls over the first full day of default, the macroeconomic mathematics become horrifying. The U.S. government collects roughly $4.5 trillion in annual revenue. Its mandatory spending, Social Security, Medicare, Medicaid, interest on remaining debt, totals $5.2 trillion before accounting for defense, infrastructure, education, or any discretionary function. Pre-default, borrowing made up the difference. Post-default, the gap can only be closed via savage spending cuts or money printing. Both paths lead to ruin. The Federal Reserve's decision to monetize the debt means the monetary base will expand massively. In 2008, QE1 expanded the base by $1.7 trillion over 3 years. Now, the Fed must absorb $36 trillion of existing debt while financing ongoing deficits. This is quantitative easing on a scale that dwarfs any prior experiment. Inflation expectations, measured by the 10-year break-even rate, spike from 2.3% to 7.8% overnight. Savers, understanding the implicit theft inherent in currency debasement, begin converting dollars to tangible assets. Gold, priced at $2,100 per ounce on Tuesday, soars to $3,400 by Wednesday close, a 62% rally in 24 hours, the largest single-day move since the 1980 spike when Iran's revolution threatened oil supplies. Cryptocurrency markets, already volatile, explode. Bitcoin surges to $95,000, Ethereum to $5,200, as investors flee fiat currency entirely. By midnight Wednesday, the global financial system is in a state of shock. The IMF releases a statement. The default of the United States represents an unprecedented disruption to the global financial architecture. The full implications remain uncertain. Translation: the world's experts have no playbook for this scenario. Chapter 3: The System Shock, 1 month of cascading collapse. Week 1 brings the full weight of consequence. The unemployment rate, which stood at 4.2% on Monday, reaches 6.5% by Friday, 1.2 million workers laid off. By the end of Week 1, it reaches 8.3%, exceeding the 2008 crisis nadir of 10% by historical comparisons. Small businesses, starved of credit and facing falling demand, begin mass closures. Commercial real estate, already fragile from the post-2020 work-from-home exodus, collapses further as office occupancy drops from 60% to 40%. The auto industry, one of America's economic anchors with 1.3 million direct employees and 8 million indirect jobs, enters crisis. Ford announces 200,000 layoffs. General Motors suspends new vehicle launches. Tesla, dependent on credit markets for growth, freezes expansion. Used car prices, which had surged 40% during the 2020-2022 supply shortage, plummet 30% as consumers pull back. Subprime auto loans, already stressed by rising rates, enter default at 12% rates, up from 3% pre-crisis. Energy markets convulse differently than expected. While crude oil prices rise, gasoline prices at the pump don't follow linearly because demand has collapsed. Americans, shocked by $8 per gallon prices, begin carpooling and reducing driving. Gasoline demand falls 25% week over week. Yet refinery margins, the profit per gallon, actually compress because oil prices remain elevated while volume drops. The energy sector enters recession within the first week. International central banks mobilize. The European Central Bank, cognizant that a US collapse will devastate the Eurozone, 20% of EU exports go to the US, announces a €2 trillion liquidity program to support European banks facing exposure to US assets and defaulted counterparties. The Bank of Japan implements similar measures, injecting $500 billion into Japanese markets. But these efforts are analogous to building dikes against a tsunami. The underlying problem, the default of the world's largest economy, cannot be hedged or isolated. By week 2, the credit card market seizes. Banks, facing deteriorating collateral and rising default rates, raise interest rates to 28% on average, and many cease new issuance. Consumer spending, which had driven 70% of US GDP growth pre-crisis, collapses 35% in real terms. Retailers announce store closures. Macy's, already weakened, files for bankruptcy. Target suspends expansion plans. Walmart warns of margin compression. The hospitality industry, dependent on discretionary spending, enters free fall. Hotel occupancy rates plummet from 68% to 42%. The real estate market, America's largest asset class worth $45 trillion, enters crisis. Home prices, which had risen 45% from 2020 to 2030, one in nominal terms, fall 25% in the span of 3 weeks as both demand and financing evaporate. Foreclosures, already rising due to pandemic-era mortgage deferrals, surge. By end of week 2, mortgage delinquencies hit 8%, approaching the 10% peak of the 2008 crisis. Banks' equity, already thin, faces wipeout. Emergency Fed lending facilities extend $3 trillion in support to prevent a cascade of bank failures. Week 3 brings a critical tipping point: the collapse of the municipal bond market. States and cities, suddenly unable to refinance existing debt and facing falling tax revenue, face acute fiscal stress. Illinois, already the most indebted state with a $140 billion pension liability, announces it cannot meet current obligations. The state's bond ratings plunge to junk status. Borrowing costs spike to 18%. Essential services, police, fire, education face cuts. California, the world's 5th largest economy if independent, faces a similar crisis. Tax revenue, heavily weighted toward capital gains from equity markets, plunges 45% as the market collapse erases $7 trillion in wealth. The state's budget deficit, projected at $20 billion pre-crisis, expands to $180 billion. Public employee pension funds, holding $1.5 trillion in assets, face projected returns collapsing from 7.5% to -15%. Underfunding accelerates from 20% to 60%. Teacher strikes paralyze major cities. New York's teachers, watching their pension funds crater, walk out, citing insufficient contribution guarantees. Los Angeles teachers follow. Within days, 10 million K-12 students are home from school, a shock to the economy as parents unable to work withdraw from the labor force, adding another million to effective unemployment. By week 3, inflation, the sleeping giant, begins to awaken. Producer prices for goods have risen 18% as import costs soar from dollar collapse. Gasoline prices, after an initial collapse, rebound to $7.50 per gallon as supply restrictions bind. Groceries see double-digit increases. A gallon of milk rises from $3.50 to $5.20. Beef rises 22%. Bread rises 15%. The Consumer Price Index, which had run 3% annually pre-crisis, spikes to 8.5% in the first 4 weeks of default. Annualized, this implies 28% inflation, a harbinger of the stagflation nightmare. Wage price spirals begin. Workers, watching their purchasing power evaporate, demand higher wages. Unions, which had been quiet during the 2010s-2020s low inflation era, resurge. Dock workers at major ports demand 15% raises. Airline pilots demand 18%. Truckers threaten strikes. Companies, unable to absorb higher costs, pass them through to consumers, accelerating inflation further. The Fed, now monetizing the debt, cannot tighten policy without causing immediate government insolvency. It is trapped. By week 4, the global currency market has undergone a tectonic shift. The dollar, having fallen 30% against the euro, 35% against the yen, and 28% against the Swiss franc, stabilizes at depressed levels. But this is not a currency repricing. It is a currency crisis. Emerging markets holding $3 trillion in dollar reserves begin converting to euros, yen, and yuan. China's yuan appreciates 12% against the dollar as Beijing sterilizes inflows, afraid of importing US inflation. Gold, which had surged to $3,400 in week 1, stabilizes at $2,800 as the initial panic subsides. But this represents a 33% increase from pre-crisis levels, a permanent revaluation reflecting loss of confidence in paper currencies generally. Cryptocurrency markets remain volatile but elevated. Bitcoin, having peaked at $95,000, trades at $68,000, Ethereum at $4,100. The psychological impact on Americans is devastating. A Gallup survey conducted in week 4 shows 73% of Americans believe the country is in decline. 58% believe a second Great Depression is likely within 2 years. 41% of working-age adults have updated their resumes. Brain drain accelerates. Canadian immigration applications surge 400%. UK visa applications from Americans spike 350%. For the first time in the post-WWII era, America is experiencing genuine capital flight and human emigration on a meaningful scale. By month's end, the economic contraction has accelerated beyond even the darkest projections. GDP, which declines at annualized rates during crises, is now estimated to be falling at 8–10% monthly rates. Annualized, this implies a 60–80% contraction, worse than any quarter of the Great Depression save the first quarter of 1933, when GDP fell 27%. The stock market, having lost $12 trillion in the first day, has shed another $8 trillion in subsequent weeks. Total wealth destruction, $20 trillion in 1 month. Unemployment has surged to 14.2%, with 21 million Americans jobless. Initial jobless claims average 2 million weekly, a level last seen in the depths of the 2008 crisis. The labor force participation rate, already declining from demographic aging, falls further as discouraged workers exit entirely. Child poverty, measured pre-crisis at 17%, is projected to reach 28% by month's end if trends continue. Internationally, the contagion spreads despite central bank efforts. European banks, exposed to US assets, announce massive write-downs. Deutsche Bank reveals 400 billion euros in US asset impairments. Credit Suisse announces 250 billion euros in losses. Banking stocks across Europe and Asia plunge. The Stoxx Europe 600 index falls 34% in the month. The MSCI Emerging Markets Index falls 42% as both direct US exposure and the dollar crisis hammer developing economies. Sovereign debt crises erupt in the periphery. Countries reliant on US trade, Mexico, Canada, the Philippines, Vietnam, face simultaneous currency weakness and demand collapse. Mexico's peso falls 38%. The Canadian dollar falls 22% despite being commodity-backed. Thailand and Indonesia, facing dollar debt burdens, face potential default. The IMF mobilizes emergency facilities, but its firepower of $1 trillion pales against the $400 trillion in global debt now at risk. By month's end, the world's central banks have deployed nearly $15 trillion in emergency liquidity support, an unprecedented intervention that dwarfs the 2008 crisis response by 5x. Yet financial markets remain frozen. Credit spreads remain at crisis levels. Equity volatility remains elevated. Currency markets remain unstable. The system, shocked by the loss of its anchor, has not yet found a new equilibrium. Chapter 4: The New Order, 1 year of adaptation and fragmentation. The months from month 2 to month 12 mark a period of acute adjustment. The political order, already fractious, splinters further. Reynolds' approval rating plunges to 21%, the lowest in polling history. Calls for impeachment emerge from both parties. A Democratic senator from Virginia proposes removal, citing catastrophic mismanagement. The Republican Senate majority, fearful of international backlash and economic ruin, secretly negotiates with the president, urging a reversal. In May 2031, Reynolds makes a dramatic reversal. In a televised address, he announces that the U.S. will honor good faith payments on the debt going forward, though at a 40% debt restructuring, effectively defaulting on $14.4 trillion while servicing $21.6 trillion. This is an implicit partial default, a haircut that mirrors the Argentine and Greek precedents. Bondholders take the hit. A $1 trillion Treasury holding becomes worth $600 billion in real terms. The market response is relief mixed with rage. Treasury yields fall from 18% to 12%, lower than week 1 peak, but still catastrophic compared to pre-crisis 4.2%. Stock markets rally 8% on the news, a dead cat bounce. They quickly resume falling as the severity of the structural problem becomes apparent. The government must raise $2.3 trillion annually in deficit spending, but borrowing is now at 12% rates. Every dollar of new borrowing costs 12 cents in annual interest, unsustainable for perpetuity. The policy response is severe fiscal austerity combined with monetary expansion. Congress, under pressure, passes the Fiscal Restructuring Act of 2031, which reduces Social Security benefits by 30% for individuals with income over $60,000, $21 million people affected, including middle-class retirees. Raises the Medicare eligibility age from 65 to 67 and increases premiums by 45%. Cuts federal civilian employment by 25%, 850,000 jobs. Reduces defense spending by 15%, $90 billion, the first major cut since the post-Cold War drawdown. Raises the top marginal income tax rate to 45%. Implements a 5% national sales tax. Imposes a 10% tax on capital gains realized by non-residents. The cuts are savage and economically contractionary. Consumer spending, already hammered, falls further as retirees see benefits slashed. Government employment, which had provided stability, now adds to unemployment. Defense contractors' revenues plunge, military bases close, Unemployment in defense-dependent regions reaches 22%. Yet these cuts are insufficient. The government's primary deficit, the deficit excluding interest payments, remains at $800 billion annually. Interest payments on the $21.6 trillion service debt at 12% rates total $2.6 trillion annually. Total government spending, excluding new borrowing, must equal revenues of $4.5 trillion. The arithmetic is impossible. The gap is closed via monetary expansion. The Fed, now clearly acting as the government's financing arm rather than as an independent central bank, expands the monetary base from $7 trillion to $22 trillion over the year, a 214% expansion. This monetization of deficits is the hallmark of currency collapse. Money growth, running at 40% annualized rates, overwhelms real economic growth, now negative at -6% annually. The result is predictable: inflation accelerates. By month 6 of the default year, CPI inflation reaches 16% annualized. By month 9, it reaches 22% annualized. By month 12, it reaches 28% annualized. This is stagflation writ large, negative real growth combined with high inflation. Wage growth, averaging 12% annually in raises and job changes, lags inflation by 16 percentage points. Real wages fall 14% in a single year, the largest decline since the post-WWII price spike of 1945-46. Savers are devastated. A retiree with $1 million in savings, earning 3% in Treasury bonds post-restructuring, receives $30,000 in nominal income, but loses $280,000 in purchasing power to 28% inflation. Pension funds, already underfunded, see their beneficiaries' purchasing power collapse. The middle class, accumulated capital eviscerated, experiences a profound hollowing. The real estate market adjusts downward. Home prices, which had already fallen 25% in month 1, fall another 30% by month 12, representing a total decline of 48% from peak in nominal terms and nearly 60% in real, inflation-adjusted terms. The largest wealth destruction in American history plays out. $21 trillion in home equity evaporates. Millions of homeowners face negative equity, owing more than their homes are worth. Foreclosures, already surging, become routine. By month 6, 1 in every 45 homes in America faces foreclosure. By month 12, 1 in every 35. Entire neighborhoods become blighted. Abandoned homes accumulate, property crime surges 40%, and the social fabric frays. In Detroit and cities already economically fragile, the foreclosure wave is apocalyptic. Some entire census tracts face 35% plus vacancy rates. Yet paradoxically, some Americans benefit. Wage earners with cost of living adjustments, government workers, union employees, some corporate workers, see their nominal income rise with inflation. Those with hard assets, land, minerals, real estate held without mortgages, see their real wealth preserve or grow. The wealthy, able to access dollar alternatives and foreign assets, flee the depreciating currency. The poor, on fixed incomes, are crushed. Inequality, already at post-Gilded Age levels, worsens dramatically. The Gini coefficient, which had risen from 0.4 in 1980 to 0.48 in 2030, reaches 0.55 by end of the first post-default year, approaching levels seen in third-world kleptocracies. The top 1% possess 40% of wealth. The bottom 50% possess 2%. Internationally, the U.S.'s role in the global order shifts fundamentally. The dollar, still the reserve currency but now seen as risky, loses share in global reserves. Central banks diversify. China's reserves shift 35% away from dollars toward euros, yen, and digital yuan. The ECB accelerates plans for a digital euro. The IMF begins transitioning the SDR special drawing right as a de facto reserve unit. By year-end, the dollar's share of global reserves falls from 60% to 42%, a shift unseen since the 1980s. Trade relationships reconfigure. Countries, fearing further U.S. currency instability, begin bilateral barter and non-dollar settlement mechanisms. China and ASEAN deepen yuan-denominated trade corridors. The EU formalizes the euro as preferred settlement currency. Brazil and Argentina pioneer a new South American currency union. The long post-WWII era of dollar hegemony begins visibly to crack. The U.S. current account deficit, which had run $700 billion annually pre-crisis, widens to $1.2 trillion as imports surge. Foreigners devalue by 30%, making imports expensive, and exports stagnate. Collapsing domestic demand plus currency weakness make competing on price irrelevant. America, once a creditor nation in the 1980s, becomes a debtor nation in the 1990s, and by 2031 becomes a capital exporter by default, capital fleeing rather than being imported. Geopolitically, the U.S. is standing erodes. Alliances, strained by the financial chaos, fray. Japan, facing its own currency pressure as the Fed's expansion weakens the dollar and pulls yen up 20%, questions its reliance on U.S. military protection. South Korea initiates secret talks with China about a more accommodating regional stance. NATO allies in Europe, seeing U.S. military spending cut 15% and concerned about American reliability, accelerate defense spending, and reduce their reliance on U.S. security guarantees. The unipolar moment in international relations ends not with a bang but with a whimper, the sound of financial markets seizing. By year-end of the first post-default year, the aggregate contraction is staggering. U.S. real GDP, having fallen 6% year-over-year, represents the worst full year since 1946. Unemployment stands at 16.5%, 26 million jobless, exceeding the Great Depression peak of 1933. Per capita income in real terms has fallen 12%, the largest single-year decline in modern history. Government debt to GDP, having been 140% pre-default, rises to 220% despite the partial default, because the denominator, GDP, has collapsed. Yet the world has not ended. This is crucial. The system, shaken to its core, adapts and endures. Capital markets remain frozen but not permanently closed. Some borrowing occurs at survivable rates, 12–15% for creditworthy entities. Trade continues, though at reduced volumes and with higher friction costs. Unemployment, while devastating, stabilizes as the labor market re-equilibrates to new lower wage levels and reduced hours. The acute panic of month one transitions into the grinding misery of chronic depression. Chapter 5. The Legacy 10 Years of Restructured Order. The decade from year 2 to year 11 marks a slow, grinding recovery punctuated by crises. The immediate priority for policymakers is stabilizing the currency. By year 2, inflation expectations become unanchored. Consensus forecasts for long-term inflation spike to 6–7%. The Fed, recognizing that unbounded monetization will lead to hyperinflation, Zimbabwe pace, begins signaling a pause in monetary expansion. Inflation peaks at 31% in year 2, driven by cumulative money supply growth and continued wage price spirals. Then something breaks. In year 3, major strikes by rail workers and longshoremen paralyze commerce. Companies, facing 25% plus wage demands from workers desperate to keep up with inflation, begin wholesale automation and outsourcing. Amazon accelerates robotics deployment. Manufacturers pivot to 3D printing and nearshoring. Shipping firms deploy autonomous vessels. Unemployment rises again to 18% as these disruptions cost 4 million jobs. Yet paradoxically, inflation begins to recede. The destruction of demand from unemployment overwhelms wage growth. By year 5, inflation has moderated to 9% annualized, still high but stabilizing. The Fed, having monetized roughly $12 trillion of deficit spending over 5 years, begins a slow tightening, raising rates from 3% to 5.5%. This causes a renewed recession in years 5 and 6, but inflation finally begins to crack. The Treasury, now borrowing at 8–9% rates, faces manageable debt service. A new equilibrium emerges. The U.S. economy operating at depressed capacity utilization, 65% rather than 85% pre-crisis, with unemployment chronically elevated at 11–12%, but with inflation moderating. Real wages, which had plummeted 14% in year 1 and a further 18% by year 5, stabilized by year 7. Cumulative real wage losses by year 10, 22% below pre-default levels. A worker earning $60,000 in 2030, one would earn $47,000 in real terms by 2040. Retirements are postponed. Labor force participation among those over 65 rises from 21% to 34%. Multi-generational households become common, as adult children unable to afford housing move in with aging parents. Housing, the shock absorber of American wealth, stabilizes by year 7 at 50% below peak prices in nominal terms and 65% below in real terms. Those who bought homes in 2031–2035 at bottom prices, typically the wealthy with cash, see enormous gains. Those forced to sell in years 2–5 at trough prices suffered devastating losses. The distribution of foreclosure pain was brutally unequal. Minorities, already bearing a disproportionate burden of the 2008 crisis, experience foreclosure rates 40% higher than white households. The political system, under enormous strain, undergoes turbulent change. Reynolds loses the 2032 primary to a challenger from his own party, a centrist senator promising restoration of normalcy. This president, Margaret Chen, takes office in January 2033, inheriting a nation still in acute distress. She negotiates a formal debt restructuring, exchanging $7 trillion of old debt for new 30-year bonds paying 6%, and retiring $2 trillion in principal entirely, a 25% haircut on affected securities. Foreign holders of U.S. debt, China, Japan, European central banks, accept the restructuring under duress. Holding defaulted securities paying nothing is worse than holding restructured securities paying 6%. But the restructuring is a political act. The world is being told that U.S. debt, once sacred, is now subject to negotiation. The sanctity of sovereign debt obligations is shattered. Emerging market borrowers, watching America default and restructure with impunity, begin to recalculate their own debt obligations. Argentina II, and III, defaults by Mexico, Indonesia, and Thailand follow within years 5 and 6. By year 7, a new international financial architecture begins to crystallize. The Bretton Woods II conference, held in Switzerland in 2037, formalizes several changes. The IMF's SDR becomes the preferred reserve asset for central bank reserves, replacing the dollar in formal policy, though the dollar remains used for trade settlement due to inertia. A new international bankruptcy court is established for sovereign debt restructuring, modeled on corporate bankruptcy law, to replace ad hoc negotiations. Regional currency blocks are formalized. The Eurozone strengthened, Yuan zone expanded, and Dollar zone contracted to just North America plus a few allied states like Japan, South Korea, Australia. The dollar's share of global reserves falls to 32% by year 10, a stunning shift from the 60% share of 2031. The euro rises to 38%, the yuan to 18%, the yen to 8%, other currencies to 4%. This is the formal end of American monetary hegemony, a structural shift analogous to sterling's decline in the 1920s–1940s post-WWI. But the American economy adapts. By year 10, certain sectors have reconfigured entirely. Manufacturing, which had been in secular decline for 40 years, partially returns. Real wages in manufacturing collapse 30% but remain above offshore alternatives when logistics costs and geopolitical risk are considered. Companies like Caterpillar, Nucor, and Boeing begin reshoring production. Manufacturing employment rises from 12 million in 2031 to 14 million by 2040. Not a return to the 20 million of the 1970s, but a stabilization and reversal of decline. Energy becomes decoupled from international markets. Domestic U.S. oil and natural gas, enabled by shale technology, become the primary energy sources. Russian and Middle Eastern oil imports fall 50%. LNG imports contract 70%. This insulates the U.S. from oil shocks, but also increases domestically produced inflation as marginal production costs rise. Technology, particularly software and digital services, becomes even more concentrated. Unlike physical goods, software exports from depressed currency America become globally competitive. U.S. tech companies with depressed dollar wage costs capture market share from European and Asian competitors. By year 10, U.S. tech firms increase exports 40%, partially offsetting manufacturing decline. Agriculture similarly benefits from currency depreciation. U.S. grain, fruit, and meat exports, priced in cheap dollars, surge. American farmers' incomes recover sharply. Agricultural exports rise 50% from pre-crisis levels. The Midwest's economy, devastated through the 2010s-2020s by low commodity prices, experiences a renaissance. Yet this adaptation is geographically uneven and socially devastating. Blue-collar workers in manufacturing hubs see wages rise in nominal terms but fall 22% in real terms versus pre-crisis. Tech workers in coastal cities see real wages rise 8% despite the macro collapse, as their global competitiveness is enhanced. Retirees on fixed nominal pensions are devastated. Government workers on COLA adjustments fare better. The Gini coefficient, after spiking to 0.55 by year 1, moderates to 0.52 by year 10, still catastrophic but not worsening. Politically, the first decade fragments into patterns of deep polarization. The left blames the default on greed and corporate lobbying. The right blames overspending. A third movement emerges, blaming the Fed for monetizing the default and causing inflation. Conspiracy theories abound. Some blame China for engineered default via financial attack. Others blame globalists for intentionally destroying American hegemony. Trust in institutions collapses. Federal Reserve approval falls to 12%. Congress to 8%, the presidency to 18%. By year 10, the prospect of another political upheaval looms. An outsider candidate, Bernie Carmichael, a populist businessman running as neither left nor right, emerges as the frontrunner for 2041's election, promising to rebuild America through nationalism and self-reliance. His rhetoric echoes the 2031 default initiator, Reynolds. The cycle seems poised to repeat. Internationally, the U.S.'s role as guarantor of global order diminishes. NATO, while holding together, becomes more European-led. The U.S. maintains its military alliance with Japan, South Korea, and Australia, but provides less of the security umbrella, forcing these nations to build indigenous deterrence. When China asserts territorial control over additional portions of the South China Sea in year 8, the U.S. protests but does not intervene militarily, a striking departure from the post-WWII playbook. By year 10, the world's GDP has grown 1.5% annualized versus 3% trend pre-crisis, representing a loss of $50 trillion in cumulative output relative to counterfactual growth. Emerging markets, hit hardest by the cascade of crises, have stagnated. India's growth averages 2.5% versus 6% pre-crisis. Africa's averages 1.5% versus 3.5%. The world has become poorer, slower growing, and more fragmented. Chapter 6, Chapters 1150, The Long Reckoning. Years 1120, Structural Adaptation. The second post-default decade marks a transition from crisis to acceptance of new permanent structures. The dollar's erosion continues, but stabilizes at 28% of global reserves by year 20. China's yuan, promoted aggressively by Beijing's central bank diplomacy, rises to 25%. The euro stabilizes at 32%. Other currencies share the remainder. This represents a genuine multipolarity in currency markets unthinkable in 2030. A critical development in year 12. Japan's interest rate spikes suddenly when the Bank of Japan is forced to abandon yield curve control after massive capital outflows. The yen appreciates 35% in 6 months, triggering a severe recession in export-dependent Japan. This serves as a cautionary tale. Japan cannot indefinitely suppress interest rates to support the yen if global confidence erodes. The implicit lesson reaches the Fed. The days of monetary dominance are over. Global capital will discipline rates if central banks deviate too far from market equilibrium. American political instability peaks during the Carmichael presidency, 2041-2045. Carmichael, elected on a platform of economic autarky, pursues aggressive import restrictions and attempts to renegotiate international agreements. Tariffs on Chinese goods spike to 45%. EU goods face 25% tariffs. Trade volume contracts further, causing another minor recession in years 42-43. But autarky proves impossible. American consumers cannot live without Chinese manufactured goods, and American producers cannot compete without access to global markets. By year 44, tariffs are quietly reduced, trade normalizes, albeit at permanently reduced volumes. By year 20, American inequality has stabilized at a new dystopian equilibrium. The top 10% hold 42% of wealth, the bottom 50% hold 1.8%. This mirrors Brazil or South Africa, once wealthy nations permanently fractured into enclaves of privilege and seas of poverty. Gated communities, rare in America before 2031, become common in every major city. Private security, private education, private healthcare, the markers of developing nations, become normal for the American wealthy. Urban decay accelerates in cities without corporate headquarters or tech hubs. Detroit's population, which had already halved from 1.8 million in 1950 to 670,000 in 2020, continues declining to 420,000 by year 20. St. Louis, Pittsburgh, Gary, and dozens of other former industrial centers become de facto developing nation cities with third-world infrastructure, third-world education, and third-world expectations. Yet pockets of renewal emerge. Austin, Denver, Nashville, and some Sunbelt metros experience relative growth as remote work, facilitated by decades of digital infrastructure investment, enables knowledge workers to migrate away from coastal megacities. Phoenix's population surges 40% from 2030-2050 as Californians flee high taxes and political dysfunction. The American economic map reorganizes around tech hubs, financial centers, and natural resource extraction, rather than around legacy manufacturing or geographic centrality. Government finances remain deeply dysfunctional. The debt-to-GDP ratio, having spiked to 220% by year 1, moderates to 180% by year 10 and 160% by year 20 as primary deficits shrink and real growth resumes. But 160% debt to GDP remains catastrophic by pre-2008 standards. Interest payments consume 22% of federal revenue by year 20, crowding out productive spending. The government becomes essentially a transfer payment machine. Pay interest to bondholders, pay Social Security to retirees, pay Medicaid to the poor, with little left for infrastructure, education, or research. Basic infrastructure decays visibly. The American Society of Civil Engineers grades U.S. infrastructure at a D+ throughout the 2040s, reflecting decades of deferred maintenance. Bridges fail, water systems collapse, roads pothole, rail networks atrophy. American cities, once the marvel of the world, begin resembling second world infrastructure. International travelers note with shock the deterioration. Years 2130, the multipolar equilibrium. By year 30, a stable New World Order has crystallized. It is multipolar, slower growing and more fragmented than the pre-2031 world, but it is stable. 4 regional blocs dominate: the Eurozone, EU 27 plus Switzerland, Norway, Iceland. 18 trillion euros GDP, 3.2% annual growth. Euro as primary reserve currency in this bloc. The EU, having faced profound threats to cohesion from the US default and global financial dysfunction, actually strengthens. European integration deepens as Brussels centralizes more fiscal authority to prevent repeat crises. The European budget expands to 8% of EU GDP, from 1.4% pre-2031, funding central investment in infrastructure and defense. The Yuan Zone, China, ASEAN 10, Hong Kong, Taiwan, Japan, South Korea, Australia. $35 trillion GDP, 4.1% annual growth, yuan as secondary reserve currency. China's 20-year strategic vision of yuan internationalization is accelerated by US default. Trade within the zone increasingly settles in yuan. Central banks hold yuan reserves. Regional development banks operate in yuan. The arrangement is less a formal currency union than the pre-WWII sterling bloc. Countries maintain monetary autonomy, but informally coordinate around Chinese leadership. The dollar zone, US, Canada, Mexico, Central America, Caribbean. $32 trillion GDP, 1.8% annual growth. Dollar as regional currency but no longer reserve of choice globally. This zone is economically integrated via USMCA and deep trade ties, but growth lags other blocs due to persistent American dysfunction. Mexico becomes a major manufacturing hub as U.S. wage depression and currency weakness offset China's geographic advantages. Mexico's GDP per capita rises to $22,000 by 2050. The commodity bloc, Middle East, Russia, Africa. $8 trillion GDP, 2.4% annual growth, no dominant currency but oil priced internationally. This bloc, less integrated than the others, benefits from high commodity prices driven by emerging market infrastructure development. Oil stabilizes at $85.120 per barrel range by year 30, profitable for producers but not constraining growth. Notably absent from this ordering is a unifying principle. The pre-2008 order was American hegemonic. The 2008-2031 order was American hegemonic but contested. The 2030 1+ order is explicitly multipolar with competing centers of power. This multipolarity is unstable by definition, but it is the new normal. The IMF's global GDP estimate by year 30 is $140 trillion, up only 12% from $125 trillion in 2031, representing 2% annualized growth versus 3% pre-crisis trend. The foregone growth represented by the default totals roughly $200 trillion in lost output relative to no crisis counterfactual, immense destruction for a single decision. Years 3140, the second cycle. By year 35, the American political cycle completes a full revolution. Carmichael is succeeded by a centrist Democrat, Keisha Walker, who promises to rebuild progressive America and restore global leadership. Walker's strategy emphasizes investment, massive fiscal stimulus for infrastructure, education, and green energy, funded by raising corporate and capital gains taxes. Growth accelerates to 2.5% by year 38, but inflation reemerges. CPI rises back to 6% annualized by year 39. the Gilded Age inequality accumulates further. By year 40, the top 0.1%, 330,000 people, possesses $50 trillion in wealth, equivalent to all median wealth held by the bottom 160 million Americans. A new class of megabillionaires, concentrated in tech, finance, and natural resources, wields influence over policy that rivals government. These techno-oligarchs become Americans' de facto governing class. Yet within this dystopia, innovation accelerates. Freed from the constraints of OSHA, environmental regulation, and labor law, due to political dysfunction preventing coherent federal regulation, American companies pioneer automation, AI, and biotech at a pace that outpaces regulated competitors in Europe and Asia. By year 40, American companies hold 45% of global patents in AI, genetics, and quantum computing, up from 38% pre-default. The consequence is increasing American autarky in high-tech sectors. American tech companies no longer need global markets to achieve scale. Their domestic market remains enormous. This allows the U.S. to pursue increasingly nationalist policies without economic devastation in tech. But agriculture, basic manufacturing, and resources remain integrated globally, creating a bifurcated economy. High-tech autarky facing global integration. Years 41-50, the new equilibrium. By year 50, the transformations are crystallized into permanence. The U.S., no longer a superpower by the old definition of military and financial hegemony, is instead a hegemon in specific domains: technology, agriculture, entertainment, and aerospace. American companies dominate global AI markets, genetically modified agriculture exports, media streaming, and satellite launches. But American geopolitical power has declined precipitously. The U.S. military still possesses 10,000 nuclear warheads and global power projection capability, but it cannot guarantee global order. When China and India clash over territory in the Himalayas in year 48, the U.S. cannot unilaterally impose peace. When the Saudi-Iranian conflict over Gulf hegemony erupts in year 46, American mediation is merely one voice among many. The world structure by year 50 reflects 5 regional powers of roughly equivalent weight. European Union, with 18 trillion euros GDP and military spending of 3% GDP, $540 billion, an integrated superpower. China, with $32 trillion GDP and military spending of 4% GDP, $1.3 trillion, the rising hegemon. United States, with $30 trillion GDP and military spending of 3.5% GDP, $1.05 trillion, the fading hegemon. India, with $8 trillion GDP and military spending of 2.5% GDP, $200 billion, the emerging power. Russia, with $3 trillion GDP and military spending of 7% GDP, $210 billion, a regional power with nuclear teeth. This quintet manages global affairs through multilateral bodies. The UN Security Council is now genuinely multipolar, with no single veto wielder. The IMF and World Bank are reformed to give voting power proportional to economic weight. Regional development banks, Asian, African, European, American, handle most development finance. American domestic politics stabilizes into a pattern of oscillation. Progressive administrations attempt renewal, fail due to structural constraints of inequality and low growth, are replaced by conservatives who attempt austerity, fail due to public demands for social programs, are replaced by populists promising national revival, fail to deliver. The cycle repeats every 12 years. By year 50, Americans have become accustomed to manage decline and dysfunctionality. The nation that launched the moon mission and built the interstate highway system now struggles to maintain basic infrastructure. Yet paradoxically, American cultural influence persists. Hollywood dominates global entertainment. American music dominates streaming. American fashion sets global trends. American cuisine spreads globally via franchises. The US remains soft power hegemon even as hard power hegemon. This asynchrony, cultural dominance without political power, characterizes American status by 2080. Conclusion: the 50-year arc. The journey from day 0 to year 50 traces an arc of decline and adaptation. The Great Default of 2031 is not civilization ending. The system survives through shock, contraction, and reorganization, but it is system defining. The post-WWII American hegemonic order, damaged in 2008, definitively ends in 2031. The world that emerges is multipolar, slower growing, and more unequal, both internationally and within nations. For Americans specifically, the 50-year arc represents a descent from post-war prosperity to managed decline. Real wages, after growing 2% annually from 1945-1973, then stagnating from 1973-2008, then being devastated 2008-2031, then recovering modestly 2031-2050, end year 50 at levels 38% below their 2008 peak in real terms. The middle class, the engine of post-war American growth and stability, is hollowed out. A bifurcated society emerges. Wealthy enclaves of high-tech innovation coexist with deteriorating cities and crumbling infrastructure. The warning implicit in this scenario is not forecasting. The future is inherently uncertain. Rather, it is a logical mapping of consequences. The U.S. debt trajectory, when extrapolated, became mathematically unsustainable by 2030. The consequences of debt default, drawn from historical precedent, Argentina 2001, Russia 1998, emerging markets repeatedly, are predictable even if their magnitude is not. A nation that cannot service its debt faces 4 options. Default explicitly, losing credibility, facing capital flight, enduring depression. Inflate away the debt, losing currency value, devastating savers, causing capital flight. Cut spending or raise revenue radically, politically devastating, economically contractionary. Grow faster than debt growth, rarely achievable when debt is already 140% of GDP. Option 4 was attempted from 2008-2031. It failed. When all 4 options are politically or economically infeasible, default becomes inevitable. The script above is not prediction, but rather a consequence map, a careful tracing of the logical implications of a default in the world's largest economy. The grimdark lesson: empires do not end with invasion but with fiscal insolvency. Rome did not fall to barbarians. It fell to the unsustainable costs of maintaining empire. Britain did not lose its hegemony to military defeat. It lost it to the financial exhaustion of WWII. The United States faces a similar trajectory. The Great Default of 2031 is not inevitable. But if default occurs, the 50-year transformation sketched above follows from immutable economic laws.